this video, I will provide some detailed instruction for Homework 3. Homework 3 is about building discounted cash flow model, and we'll use Tesla as a case. Tesla is a company that produces EV, electronic vehicles, and the background is provided here. You can also access their 10K filings. So you can just go ahead and click this. It will direct you to its 10K filings, which is available on the website. So this is actually SEC's website. It is their official 10K filing. Now let's go directly to question A. So read item 1 in the 10K of Tesla. And I think that you should feel very familiar with this type of question. It is related to the previous homework. So we can just go ahead and click item 1. And you can just read all of those overview here. Summarize the vision of company. How does Tesla break down their business segments? What's the proportion of each segment over total revenue? You can have an idea of the vision here through this paragraph. And related to the segment is here. There are 2 segments. And the proportion of each segment over total revenue, you can go to their financial statements, which is here, click on it. Go to their income statement, you're going to see the revenue that is related to total automated revenues and the revenues that are related to energy generation and storage. And you will just need the proportion of each of them. So use this total revenue related to automated sales divided by the total revenue. That will be the proportion of this business segment. And another one is using this proportion, this part divided by the total revenue. You can just use the 2021 figure. And as you notice, there is a third part here, which is the services and others. As you know, Tesla also strives to provide good service and maintain a good customer relationship. So going to the second one, we'll actually start to build our model. Before building our model, we need to figure out some model parameters, the input for perform a model. So question B and question C is to figure out what should be the appropriate model parameters. For question B, we will focus on the most important thing about discounted cash flow model, that is to project sales. So we're going to use 1, 2, 3 methods that we'll cover in the lecture. So let me just open the Excel here. Focusing on question B, we're going to forecast sales based on these methods and decide which forecast to use. Now for this model, so this Excel file contains the complete model for DCF. And you can further on, if you do your project, if you want to use this model to value other firms, this will be a good template. So there are income statements, balance sheet, cash flow statements, and some small parts to explain further details of items inside income statement and balance sheet. Now for income statement, the sales forecast is here. I combine them together just to save some of the spreadsheet. So there are 3 methods here. The first method is the compounded annual growth rates method. Second method is based on the regression method. The third one is related to just taking the simple average among all of these year-on-year growth rate. Now we just need to find the total revenues. I have already highlighted the total revenue in the income statement, so it won't be very hard for you to find them. So this income statement gives us the total revenue from 2017 all the way to 2021. So this column will need to input the total revenue. So the total revenue here for 2017 is 11 billion. Now for 2020, it is 31 billion. For 2021, and we can see we already have the year-on-year growth rate for each year. It's pretty volatile here. That's why we need to use different method. So for compounded annual growth rate here, so we just need to use the formula. And the formula is equals the ending sales divided by beginning of the sales, raise it to the power of number of years, 1 divided by number of years. So how many years in between? 1, 2, 3, 4, 4 years, and minus 1. And then for average year growth, we can just simply take the average here, enter. And then for the regression method, I think it's very helpful if you understand this scatter plot. So the scatter plot here plots the revenues for all these 5 years. And the fitted line here for this revenue curve is the regression that we will perform. So here its slope equals to 9,420, and its intercept is here, very close to 0. So for the slope to the model is actually here. We just need the growth rate. So we explained it in class. So I'll just summarize the explanation. Here, we'll just use slope equals. So the x value and y value. So the x value will be the years. Y value will be the total revenue. Okay, enter, and you're going to see that this is the slope here, but that's not the growth rate. Okay, it's not the end yet. So the growth rate will be divided by previous sales. So we actually, the numerator is this year's, so the most recent, the forecast sales minus the sales in 2021 divided by the sales in 2021. So let's say if we extend this regression line to 2022, and we want to know the predicted value predicted by this ordinary least square, this OLS model. So the predicted value in 2022, so look at the regression line. If we extend this regression line here, the predicted value will be here. So to calculate the growth rate, we'll use the predicted value here minus the predicted value here in 2021, and then divided by the value of 2021. And then we'll get the percentage of the growth rate here. So you can just simplify this model, simplify this method, you're going to see that so the intercept will be canceled out because the predicted value all use the same intercept. And then for the x value, 2022 minus 2021, that equals to 1. So that only leaves the slope here as the numerator. And the denominator is still the predicted value here in 2021. So I'm going to just calculate the predicted value here using the model. So, so intercept y x plus slope y x times 2021 bracket enter. Okay, so we have obtained it, 3 different forecasts for sales. Now, for this case, for Tesla, its sales is very volatile. So instead of just looking at this year-on-year sales growth, the revenue is relatively easier to forecast. So we're going to use a more consistent method. So here, the regression method provides a relatively more consistent estimate. So we're going to use this 19% here for the model later. But remember, we can change this sales forecast later on as we keep on adjusting our model. And then for question C, we're going to keep on calculating some parameters. So there are 9 different parameters. Okay, we can start working on them. So for net operating cost over sales, so we first need to graph the operating cost over sales. So it's actually from here. So the operating cost is the cost related to operations directly. So there are 1 items which is right next to total revenues that is called total cost of revenues. These cost is directly related to revenues. So we can think, or we can treat this as the operating cost. And then here, we have also operating expenses. So add these 2 together, that will be this operating cost. So enter, and we get 5 different numbers from 2017 to 2021. And depreciation is actually in the cash flow statement. It is not, so some financial statement will write this depreciation down, but some will just produce a raw number, a net number here. So what we need to do, we can go to cash flow statement and find the depreciation number here. So depreciation, amortization, and impairment. So there are 5 different numbers here. We have this 2019, which is repeated column. So grab those depreciation from there. So we get these numbers here. The net operating cost will be the operating cost net of depreciation. And the sales will be the total revenue. Here again, we're going to use this column. We're going to use this row for a lot of times. So for net operating cost over sales, it's nothing but just take the ratio of net operating costs over sales. So drag it all the way to 2021. And you're going to see that this net operating cost over sales steadily decrease over time. So I also use regression method here. We're going to see later that this is very, very accurate in terms of predicting the operating cost. The regression that I use here is we're trying to know how much proportion of sales can explain net operating costs. So sales, net operating costs equals intercept slope times the sales. So this is the model here for this regression. And you can see that its R square is almost 100%. So it's very, very stable. So this proportion of sales that can explain net operating costs. So this regression has a perfect fit. So actually, I think it takes care of this fixed effect here, the intercept here. So the regression method has a more accurate prediction of future net operating costs or the cost of goods sold. So I'm going to leave this here, and we can first try to use this parameter for net operating costs. And then here, trying to use this regression method for sales forecast. So later on, there will be a question asking you to change your method for this parameter here for net operating costs over sales. Here for interest rate on debt, so we'll just need to find the interest. So the interest expense is here. So I already highlighted. So here for 2018, so that's here, divided by the amount of debt, so which is in balance sheet. So find 2018 here, enter. So it's negative since the number in the income statement here is negative. So I will just need to put a minus sign. Okay, and I can drag it, but the number will be weird. So I need to put it here for 2019. And then for balance sheet, this one is in for 2019, this one is in here. And for 2020, it's here. Okay, you can obviously tell that interest rate on debt, it's very stable, roughly 7%. So we can just feel comfortable using the last interest rate on debt, which is 7%. So moving on to the next one, for current asset over sales and current liability over sales. So these two is relatively stable over time. So we can just use these, drag it over. The number is not correct. I need to move the box here. For income statement C10, so let me see if income statement C10 is the right revenue that we need to use. So income statement C10, yes, it's the revenue in 2020. So here, we need to use the current asset in 2021, income statement B10, that's the revenue in 2021. Okay, good here and here. So current liability, put it here for current liability. So income statement C10 is the right revenue. Here, drag it over, not here. Current liability. Okay, and then here I can just take, since they are very stable, you can see from this graph, right? We can just take the average. Or you can use the latest value, which is 20%, 46%. It shouldn't cause a lot of difference here. For growth of other liabilities, so we can use year-on-year growth. Since it's other liabilities, so this item is not necessarily related to sales. So we're going to forecast the growth of this other liability just based on these historical numbers. So equals year over this minus 1. Okay, and then it is, you can see it's very volatile. So I'm going to use the recent 2 years number. So take the average of the recent 2 years. And there's a reason for doing that. You're going to see later that starting from 2020, Tesla had profits instead of loss. Before 2020, so 2020, 2019, 2018, 2017, Tesla was making losses. If we want to do a forward-looking forecast, it's better to use recent numbers. For cash over sales, okay, you can just follow the step here. I'm going to drag it here and change the input. So C10 is the right revenue. Here, drag it over. Okay, B10 is also the right revenue. Again, there is a structural break between 2019 and 2020, so it's better to use the recent average. Next, we can go to, there's nothing here for cash flow statement. We just use the depreciation amount here. So we need to also make an assumption based on fixed assets. So how will Tesla grow its fixed assets? And how will Tesla depreciate its fixed assets? So we're going to figure out it here. So usually in their 10K, you're going to see a small section explaining explaining some details under the fixed asset items. So you're going to see some conventional breakdowns of fixed assets. So here for Tesla, there are machinery, equipment, vehicles, office furniture, tooling, improvements, land and buildings, computer, and construction in progress. So here for our PPE estimates, we can just follow everything here. This is good. And C10 here is the revenue. B10 here is also the revenue. Okay, for the gross PPE, so good. So this one is the net fixed assets or net PPE. Okay, we subtract the accumulated depreciation. So here the book value is here. So these numbers are book values and these numbers are net values. For Tesla, it's similar to CAD. Our fixed asset assumption is probably better to make on net fixed assets over sales instead of fixed asset at cost. So here we can just use the average of the recent 2 years. And then for calculating depreciation rates, we need to do some more detailed analysis here. So each of these machines is associated to some estimated useful lives of the assets. So for example, for machinery, equipment, vehicles, and office furniture, the lives is estimated to be 3 to 15 years. And here, when we are depreciating each of these fixed assets here, we are depreciating them based on usually it is based on straight line methods. And I check in 10K, you can also check it. It has been specified that these are Tesla is using the straight line depreciation method. So therefore, that makes everything easier. We can just get a median number between 3 to 15. Now to calculate the median number, so it equals to 3 plus 15 divided by 2. Here we can see the average depreciation rate. That would be just 1/9. So approximately we can depreciate the machine here. This is the book value divided by 9. And every year it will be depreciating at this rate, 11% for 9 years. So the all the book value will be gone. Then we want to take the average depreciation rate. So that will be the sum product. So weighted average of here and here. So each of these represents the proportion of machinery, the proportion of building, the proportion of computer, and each of these represents their specific depreciation rate. We're going to use the depreciation rate of machine times the proportion of machine plus the proportion of building times the depreciation rate of building. So take the weighted average of the depreciation rate. The weight will be the proportion of each of these fixed assets over the total fixed assets. Okay, so we need to enter the value here as well. So the proportion will be machine over the sum This is just for checking. If the calculation is correct, adding all of them together should equals to 100%. For depreciation rate, we can use the last 2 years average, which wouldn't make any difference because it's just 10% very stable. And then we can go to a model building here. For sales, it equals to here. For current assets over sales, so J6, J7, J6, J7, net fixed assets over sales, cost of goods over sales, depreciation rate, growth of other liability, cash over sales, debt over sales. Hold on, this is debt over assets. So this number. Interest rate on debt. Okay, then we can start building the model based on all of these assumptions. So for sales, it's growing at a growth rate here, so equals 1 plus the growth rate. And for cost of goods sold, it equals minus cost of goods sold times sales. It's proportional to sales to the sales. In taxes, I'll leave taxes later. For dividends, equals profit times the dividend growth, which is 0. That's why I can put it here first. And then I can go to current asset, current liability first. Current asset times sales. Current liability times sales. I need to add a dollar sign. Here, add a dollar sign. So I have used these three already. And then net fixed assets over sales. Net fixed assets is here, equals net fixed asset over sales times sales. So that will be the net for net fixed asset. Enter. And moving to the next, we use this already, cost of goods sold. Depreciation rate will be here. So the depreciation amount is given here already. We're going to use this. And the next one we can calculate is accumulated depreciation. That would be the previous accumulated depreciation plus this year's depreciation. Enter. So getting these two numbers means that we can calculate the fixed asset at cost. So here, this, add this. And then I have used other liability, the growth of other liability already. So here, using growth of other liability, 1 plus the growth rate. Enter. Finally, for debt. So for debt, the assumption is here. So debt equals to some ratio. So we want to keep this debt over assets ratio at 13%. So therefore, debt will be a function of total asset. So this ratio times total asset. And then for cash, cash is also a function of sales. So I have used this cash over sales, debt over assets, interest rate on debt. Was used here. So the formula is here, it was given already. Then we can take care of taxes. For taxes, Tesla carries some tax loss from previous years. So here, this can be a negative number. And when Tesla calculates taxable profit, it can deduct this 65 from its profit. So it will be the maximum between taxable profit plus 65. If you do not add a minus sign, that will be just this profit before tax minus 665. If you add a minus sign, that would be profit before tax, adding this cell. Compare it to 0. And here, that would be equals to the minimum of here plus and 0, whichever is lower. So that if this one adding this one is a positive number, then there will be no more tax assets from previous year. So this will be 0. Effective tax rate in this case will be just here on the taxes divided by this. Just use here. tax rate times here taxable profit, whichever is bigger. Then I can drag all the way to the 5th year. Drag it. Okay, let me check my calculation for effective tax rate. So it should be tax over profit before tax minus okay, everything looks good. I can move on to calculating free cash flow. Add depreciation back. Depreciation minus increase in current assets equals current assets is here. And I want to increase current liability. So delta current liability minus increasing fixed asset at cost. Net interest after tax. It should be net interest. So G20 minus here. So this is interest payment minus interest income. And then do the tax adjustment. We should add the minus sign here because the original tax, the original interest, net interest should be a minus, should be a negative number. So here we should add back this expense. So that's why we add a minus sign here so that it becomes a positive number. Finally, free cash flow equals to the sum For pro forma, it equals to this. For terminal value, it equals to the 5 years value times long-term growth rate divided by WACC minus G. For enterprise value, NPV, the rate is WACC, all the values here, and then I would like to add the mid-year discounting, 1 plus WACC, raise it to the power of 5, enter. Add cash back. Asset value is here plus this. Subtract year 0 debt. So first find year 0 debt equals the sum of year 0 debt equals here. So there should be a minus equals divided by number of shares outstanding. Number of shares outstanding is here. Share value would be equals to this divided by number of shares outstanding. This number of shares outstanding is also measured in million. Okay, good. So next, perform sensitivity analysis. So this should be share value, share value. And for two-dimensional, this is to make sure that the share value is positive. So for column input, it's net fixed asset over sales. So net fixed asset over sales is here. Row input is cost of goods over sales. Okay. Okay, now we have completed question C, and we have calculated the estimates for share value and also perform the sensitivity analysis. So then you can provide your own analysis based on the sensitivity analysis, comment on the relations of sales growth, and evaluate its impact on the share value, and also comment on the impact of cost of goods sold over sales and net fixed asset over sales. Based on these two sensitivity analysis, you should be able to figure out what drives the profit and loss of Tesla. So I'll leave this part to you for you to provide some of your insights here based on this sensitivity analysis. Now, the next thing here is to adjust the model, use the regression method to estimate the cost of goods sold in pro forma model. So currently we are using the cost of goods sold from income statement based on the average. So here we are using the latest cost of goods sold as the estimate. But I just mentioned that the regression method provides a much precise estimates. So for the net operating cost. So we can use the model here. So change this projection of net operating cost to this predicted value by the model. So what we can do is make a copy of this. And then we can change the calculation for cost of goods sold. So let me write down the model. So the model is equals to, so net cost of intercept plus slope times sales. So here we'll just follow this model. This equals, go back, intercepts plus slope times sales. Add a minus sign here. And drag it. I think I should fix some cells. I'll fix the cells here for intercept and also for the slope. So don't need to fix cells. And I see the error here. So I think I need to fix here the dividend growth. I fixed the wrong one. Okay, and I believe here also needs to be changed. Okay, good. Then we can move on to the next question. And you can answer the question here, what's the estimate of share value after the adjustment? So after the adjustment, I believe it's here. Okay, you can answer the share value here. And then G. So Tesla had two important news in January 2002. So one is about its sales forecast. Still in 2002, it will enjoy a big increase in sales growth, which is above 50%. Currently, our forecast is 20% for all the following years. So we're going to incorporate this forecast for 2022. And then the next one is Elon Musk's decision to slow the new Tesla model and to focus on addressing the supply chain issue. So it will inevitably raise the cost for the firm. So we're going to incorporate that as well to the cost of goods sold and also the growth of fixed assets. So the adjustment is made here. So first, increase operating costs due to these concerns. So we're going to change and use an if statement to represent, instead of steady growth, we're going to incorporate a gradual growth of cost of goods sold over sales and also gradual growth of fixed asset at cost. Here, cash cannot go beyond $30 billion, and the stock maintains at the same level, plug change to that, and also change the sales growth to 2022 and change it to 50%. Change the sales growth to 50%. So let me first do A and then B, C, D, E, and G. So here equals, so I'm going to write a big if statement here. So if this is less than 65 and sales cost of goods sold equals to 88 times sales. If this is false, and this sales will be greater than 65. So if it's greater than 65 but less than 100, sales equals to here times 65 plus 84 times 100 minus sales minus 65. Sales minus 65. Here, these are fixed. Okay, and this bracket can be closed. Not yet. Here, if this is false, so inside this if statement, if this one is true, then execute here. If it's false, then sales equals to here, 88 times 65, 88 times 65 plus 84 times here minus 65. Fix it. Plus 80 times sales minus 100. Close the bracket. Okay, so let me check the bracket. Here, if this. Okay, and this if statement is a bracket 2. Enter. And a minus sign. Okay, good. And then move on to the next. If I want to incorporate this, fixed assets at cost. So I can basically copy all of those things here to fixed asset at cost here. Change it to the sales. And drag it down, drag it down. Enter. And here, since our assumption is made on fixed asset at cost this time, so for net fixed assets, that will be here. Don't need a minus sign. Net fixed asset equals to, I can just drag it. So next one, maximum cash balance. So therefore, it equals whichever is lower, either the original cash balance, so using here, times sales, or this 30. And stock level maintains in 2022 level, and debt is the plug, equals assets minus liability, other liability, stock, okay, so that completes question G. For question H and question I think you can provide your own analysis by looking at a model here. So in this part, we identify some drivers through this sensitivity analysis. It's mainly through two things. One is to increase its sales, but at this point, increase its sales without reducing the cost for Tesla is not necessarily a value creation activity. So for Tesla, mainly in their previous years, is to reduce their costs, reduce their operating costs, reduce their cost to produce their products, and then also reduce the cost of raw materials. So reduce the cost in every aspect of the company. So I think in 2020, they have started to enjoy some economy of scales. And then in 2021, the effect has been shown in their growth for the profitability. And then finally, summarize whether Tesla is overvalued or undervalued, and provide 3 reasons for bullish and also bearish views.